Yap, the Senior Investment Strategist at Standard Chartered Bank, joining us on the show. And Fook, hi, morning. Thanks for your time. I was going through your report, and very interestingly, you've kept your construct very positive, and you've also mentioned a glass half full approach. Give us a sense on what is driving this confidence, although overall macros are looking good in terms of the global economy. But could there be a trigger that could lead to this glass half full approach being slightly threatened?
Yeah, no, thanks very much for having me here. Yeah, we are optimistic. I think the Fed rate cuts are going to be underpinning a soft landing scenario in our view. That is our base case. So we've got a 60% probability of a soft landing in the US. We expect one more rate cut from the Fed this year and another 3 cuts next year. They'll bring us down to 3% on the Fed funds rate by the end of next year. So this is going to be, positive for the markets. I mean, historically, we've seen the pattern. If you avoid a recession in a Fed cut scenario, markets tend to do well. So we are constructive. We do expect a soft landing. We've underpinned really by the Fed rate cuts. And we're going through the earnings season at the moment, and it is positive. I think we're seeing 2025 earnings consensus moving up a little bit to around 11.6% now. I think at the start of the earnings season, it was below 11%. And then we're seeing the growth in earnings accelerating next year in the US. Estimate, again, around 14% consensus. So the setup fundamentally is positive. I think, of course, you'd have risk and volatility in terms of inflation if that comes out higher than expected. You've got your trade news as well. It's fading a little bit, but again, that could come up again. If you you ask me about what is the probability of something throwing a spanner in the works. I mean, we do have a 20% probability of a recession, in which case things will not be looking so good. Labor market weakness is something we're watching very closely. But it's exactly because of the labor market weakness that we see that the Fed being able to respond and cut rates. But yeah, we are constructive over the next, towards the year end and over the next 6-12 months.
How do you look at asset classes like gold and equities in this scenario? Or do you think there's enough headroom for gold to go up from here, even though there has been an almost 10% correction in gold in recent times?
Yeah, we continue to like gold structurally, and we do see the pullback as a buying opportunity. We have our 12-month target at 4,500 actually. We do see ongoing demand for diversification, and that will be strong, not just from central banks. I think a lot more investors we see are being aware of the importance of having gold as a diversification asset within their portfolio. So we are overweight on gold, along with our overweight on global equities. Where we are underweight actually is credit, where we think that the spreads are really just too tight to warrant the risk. You can get most of the fixed income from owning your sovereign bonds rather than taking on credit risk. But gold and equities is where we are overweight.
China and India, where are you overweight on?
Yeah, within Asia, Japan, our preferred market is China. I think India continues to look very good on a medium term, longer term view. But the earnings are still looking at negative in terms of the earnings revision. We've seen a lot of fiscal support, tax cuts that could be positive support for some of the consumer discretionary sector. That's one of the sectors we like. We like that as well as the financial sector. But for the broader market within India, we think that we want to see a bit more improvement in terms of the earnings spread before we turn positive. So India is a core allocation for us at the moment within Asia ex-Japan.
Okay, Fook, great to have you on the show. Thanks as always for your time.
Thank you.